Welcome everybody, and thank you for joining us for our at least once a year market update. We got a great guest with us today in Daken Vanderburg. Just a couple announcements here, and I'll turn it over to Daken. So I just want to let everybody know that our annual client appreciation event, our tax shredding, is on Tuesday, October the 24th. So we'd love to have you guys come out. Last couple times we've done it at Odd Muse, and it's been a lot of fun. So we invite you to come out to that. Just look for communications from us in that front. Wanted to also update you guys on some of the content that we're putting out there. Specifically, Holly and I, we've got a newsletter that we're consolidating called the Nexus Note. Where we're going to take Holly's coffee chat and my ACE's advice newsletter and kind of put those together to just provide you guys with some content on the things that are going on in the world and tying that to just the things that we love to do for clients. So we'll have an opportunity at the end of this for you guys. We'll send an email out and you guys can jump on those if you're not already on them. And also we'll put Daken's market update as a part of that as well. So now I want to jump in and talk about Daken. So he is the Chief Investment Officer at MassMutual Wealth Management. And as you probably know, Nexus is a part of the MassMutual advisor network. And Holly and I are very mindful about who we have decided to use as our mothership. And we're just very excited about the innovation that they do in the holistic planning space, and obviously a long history of being in the protection business. But one of the things they did to bring Daken over was to really innovate in the wealth management space. And so he's been here since 2019, and we're just excited about the things that he's done to really give us some strategies and a platform for providing services to you guys. So just a little bit about Daken. He's the Chief Investment Officer at MassMutual Wealth Management and MassMutual Trust Company. He's been in the business for 20 years. Came over to MassMutual in 2019. Formerly Chief Investment Officer and founder of Granite Peak Asset Management, Senior Investment Associate, Bridgewater Associates in Portfolio Construction and Strategic Projects. He was Head of Research and Portfolio Management at Chartwell Investment Partners, and was a partner at Gamma Capital Partners, where he later became the Chief Executive Officer. Got his degree at University of New Mexico, studied at University of Pennsylvania and Columbia University, and has a MBA from MIT. So, and holds a CFA designation. So thanks for joining us, Daken. I'll turn it over to you.
Great. Thanks, Andrew. Thanks, Holly. Afternoon, everyone. Thanks for joining. So a lot of slides. We're going to talk through a number of things that are happening. I will start with kind of the summary, which is, candidly, it's probably the most interesting time I have seen in many, many decades from a markets and economies perspective. I'm a student of history. I spent a lot of time looking at data. I'm a simple person. I like simple charts, and I will try to walk through essentially what is taking place right now. At the surface level, it's kind of a pretty quiet time. Markets have been up, things have been reasonable, but boy, underneath the surface, it's a remarkable time to be experiencing economies and markets, and we'll spend a little time working that through. So should be a fun, interactive, hopefully, presentation. There is a chat feature on the slide share up above or below, depending on how your format is set up. If you want to enter a question, you can go ahead and do so and put it in there. We'll make sure we try to address those after the fact, and always feel free to reach out to Andrew, Holly, and ask questions, and I can follow up with you afterwards as well, and we'll leave some time at the end to be able to do so. So with that, let's go ahead and start. So 4 main items, simple presentation to some extent. We're going to go back before we go forward. So you don't have to be a markets whiz, you don't have to be an economist, you just need to spend a little time sort of thinking about what's going on right now, and we'll spend a little time just doing that. We're going to go back before we go forward. We're going to talk a little bit about 2022 and how unique it was. We're then going to jump to the market performance. So this year, markets are up, things to look, at least at surface level, pretty good, but there's some really interesting dynamics that are taking place. We're then going to jump a little deeper. So it's the economy stupid. That was a famous quote by James Carville to President Clinton back in 1992. No matter what's happening in markets, we always want to look at what's happening in the economy. And we want to spend a little time there, despite all you hear and all the jargon that we tend to use in the investment industry. It's very simple, really, what's going on. We have printed a remarkable amount of money, and that has a lot of implications. So we'll spend a little time just talking through that. Lastly, I've got this 3-slide section called the trifecta of doom. I know that sounds scary, but there's some really interesting dynamics that are taking place right now that have, again, lots of consequences for what we're going to see in the economy. We'll then zoom way out and wrap this up with, I think, what will be a optimistic and hopeful perspective as well. So hope you have your popcorn, lots to cover. We're going to move through this fairly quickly, but again, we'll open this up to questions as well. So let's go back before we go forward. Let's start there. This shows every single year since 1977, right? So each line represents 1 year. And here's what you'll notice. The orange is 2022. So everyone knows this. The stock market was tough in 2022. It was down, right? It was the third worst year since 1977. Tricky market to navigate. You all saw on your 401ks and brokerage accounts, I'm sure that stock market went down. We lost money collectively. Difficult time. What made 2022 so difficult is this chart. This is the same exact orientation. So this shows essentially the cumulative growth in the bond market for each year since 1977. Each line represents 1 year. And the orange line represents 2022. Okay, I've sent this out a couple of times before. What made 2022 so unique was not only did stock markets go down, which happens periodically, we know that. In fact, I have a chart at the end that'll kind of demonstrate that a little more clearly. Bond markets got absolutely clobbered in 2022. So if you are a sort of typical portfolio, you have some stocks, you have some bonds, maybe some real estate. What made 2022 so challenging was that everything went down. Bonds really got hurt, stocks got hurt, real estate went up, at least in dollar terms. We'll talk about that in a second as well. So let's start with that framing. 2022 was a really difficult market for a lot of individual investors, me included, and we came out of that into 2023. Okay, now let's jump to 2023, second section. This shows a handful of individual growth of a dollar charts, right? So you start with $1 in the S&P 500, and you've got, and this was marked as of a couple of weeks ago, but you've got, call it $17, right? $1.17. So we've had a 17%-ish return, depending on when you mark it, including dividends in the S&P. As you look around the world, that's the other lines, the S&P 600, EFA, which is developed markets, international, emerging markets, which is the light blue, preferred stocks, which is the yellow, and then the Barclays Intermediate Government Corp, which is a bond index, basically. You can see that's kind of flat. So at least from some perspective, S&P 500, US stock markets, those are up. I think we all sort of know that. We've felt that for 2023. Here's what's so interesting about this year. If you hold a portfolio that has something other than just the S&P 500, so if you hold individual securities, for example, if you have a portfolio, SMAs, a lot of different things to hold, although the S&P is sort of the dominant that is out there, it turns out that the vast majority, roughly 60-65% of the returns from the S&P 500 came from the Magnificent Seven. That is 7 individual stocks. So let me orient you to the chart. Again, we start with $100. At the very, very bottom of the chart, you'll see the indexes, S&P 500, S&P 1500, and S&P 500 value. That's the one I showed you earlier. $100 turns into 117, or $1 turns into $1.17. What's so remarkable this year is that we saw 7 stocks really account for the vast majority of those gains. NVIDIA, Meta, Tesla, Amazon, Apple, Alphabet, Microsoft, right? Those were remarkably powerful generators of return. They had high growth stories. And so an NVIDIA tripled. If you owned NVIDIA at $100 at the beginning of the year, you now have $300, right? Really, really strong performance. Many, many, many investors have not held those Magnificent Seven, and that's logical. If you look to the beginning of the year, as an example, some of these companies had very, very, very expensive stock prices. NVIDIA is a great example. We use a measure called price to earnings. So what is the price of the stock relative to how much earnings the company produces? And at times it's been at 200 of price per $1 of earnings, or $250 of price per $1 of earnings. That's a very expensive ratio, and you have to make some very strong assumptions. So if your portfolio is built based on the premise that you want good quality companies at good price, you oftentimes didn't hold these. So many investors are looking at their portfolio saying, stock markets are up, but if I have a very high dividend driven portfolio, I probably haven't done that well. And that's this chart here. So this shows year-to-date returns by bucket of dividend yield. Let me explain. Far left, that's the S&P 500 in the light blue. Again, as of marking of this chart, it was up roughly 16 or 17%. And then I take all the stocks in the S&P 500 and I just group them by their dividend yield. So far left, those companies that have a dividend yield of more than 3.5% as of the end of 2022, we're down 3% for the year so far. S&P 500 is up. All the high quality, high dividend yield paying companies are down. Those between 2.4 and 3.5% dividend yield were flat for the year. Those were between 1.6 and 2.4% dividend yield were up 3. And as you can see, when you get down into the bottom bucket, those companies that paid almost no dividend or no dividend at all were up 39% so far for the year. Okay, so the statement that we're essentially making is those companies which had really strong balance sheets that were paying dividend yields have not done very well in this small period of time. Those companies that had very high valuations were very expensive, but had growth stories like NVIDIA, which was an AI play to some extent, an artificial intelligence play. Those companies have done really, really, really well. Okay, zoom out. Anytime we have an anecdote like that, let's zoom out. That is not generally the case. Historically, really high quality companies with good, clean balance sheets that are strong, stable generators of cash will tend to outperform and perform well in the long term. But if you have a portfolio that currently doesn't hold those stocks like NVIDIA and Microsoft, your portfolio returns have likely been a little challenged. That's just good knowledge to have. We're going to explain in a moment why that's taken place, but just kind of keep that in the back of your mind for a second. Okay, let's turn the corner. Let's jump into the economy. This will start to answer the question of why. What are those differences and why has that happened? So this is the first chart, and this is the chart you probably heard a lot of, 12-month percent change in United States inflation. Let me just explain inflation for a moment. You've heard it, you've seen it in newspapers, it's all over the press. This was largely why stock markets and bond markets were down in 2022. If I hold $10 in my pocket, I'd have $10 in my pocket and I walk into a store, let's say today I can buy 10 loaves of bread. Okay, let's just imagine that was the ratio. $1 per loaf of bread. $10 buys 10 loaves of bread. If I walk into the store tomorrow and I still have a new $10, and now I can only buy 9 loaves of bread. Okay, that's sort of the definition of inflation. The price in this example of bread has gone up. It's still just a loaf of bread and I've still got $10, but the price of that bread in dollars has gone up. That's an important part. Probably are very aware of that. All of the expenses that you had have probably gone up. The reverse of that, equally as important, the value of our dollars, right? The cash we hold in our pocket has gone down. That's the destructive part of inflation. We can purchase less with the same amount of dollars. So in the United States, we use a measure called the CPI. It's actually not a great measure, but it's sort of the dominant one that's used. There are better versions. But for a moment, we can look at this chart, and this shows the percentage changes in US inflation for 12 months. And you can see this goes back to 2013, but it's similar before. Kind of bounces between 0 and 2%, up and down, up and down. And then all of a sudden, inflation explodes following sort of the end or end-ish of COVID. And a number of things took place. So when inflation increases, it becomes more unstable. It's harder to plan. Do I buy the house? Do I give my employees more wages? Am I going to get more money? All of these things start to create questions, as well as if I'm holding a bond that is giving me 1 or 2% yield, but inflation is 5 or 6%, I'm basically losing money because my dollars are declining faster than what I'm making money. So that creates a bond market reset, right? Big problems, big problems. The Federal Reserve, our central bank, does not want inflation. They have two jobs: to maximize employment and to keep stable prices. And if stable prices are not happening, then they're in trouble and they got to fix it. Let's go to why. Why did we have inflation? So you probably knew and felt inflation went up. Let's go to why. Three main reasons. Number one, pent up demand. We were all locked away from COVID. Schools were closed, businesses were closed. We had to stay home, no travel, no reservations for restaurants. All of those things took place. All of a sudden, COVID begins to end and policies loosen. Everyone goes out, starts traveling, buying things, remodeling houses, spending, doing all the things they didn't do before, and doing that in large form. So an increase in demand. People bought more stuff. That's about 20% of the explanation. Second explanation is supply chain disruptions. So let's imagine you wanted drywall for your home to fix walls in the house for a remodel. Historically, there may have been 10 drywall producers in the world. All of a sudden, China shuts its ports, right? Manufacturing problems. You can't get the same supplies. Now there's 3 suppliers that we have access to, a couple in Canada, one in the United States. What do? Prices go up because the materials go up and there's less demand, less competition. So supply chain disruptions caused about 20%. This chart explains the main cause, the third cause. In the United States, we have something called the Federal Reserve. Sure, you've heard that name many times before. It's the central bank of all banks, the banker of last resort. They have some very simple tools, crude tools, one might add, and I think they would argue the same. One is they talk. Believe it or not, it's actually a powerful tool. They talk about what they're going to do. The market actually adjusts for them. 2, they can raise and lower rates. We'll talk about that in a little bit as well. And 3, third tool is this tool called the Federal Reserve balance sheet. Let me orient you to this chart. So on the axis, on the y-axis here, you'll see $1 million, $2 million. That is millions of millions, which is $1 trillion. Okay, so when you see a 1 million, that's $1 trillion. And what they do is a tool that wasn't really even used very much before. Here, and if you look at the line, this goes back to 2002. In the global financial crisis, rates were very, very low, and all of a sudden we had banking system that began to seize up. It began to stop. People stopped spending money. They stopped lending money. Lots of problems. We were literally sleeping in the offices, watching the banking systems every night to make sure that things were operational. And they remembered this tool. And basically what happens, and I'm obviously simplifying, but they turn on a computer, they print out some currency, some actual dollars. They walk across the hall. They use those dollars to buy bonds in the marketplace. Those people that hold the bonds now hold cash, and they go use that cash to either buy other assets or go spend. That's literally what that process looks like. Analogous to what's called helicopter money, the idea that someone goes up in a helicopter and throws money out of the helicopter. It's sort of the same idea, just executed through the balance sheet expansion or buying bonds. Okay, so in the global financial crisis, this tool that was hardly used, the entire tool expansion during the actual recession, that's that gray bar in 2007, 2008, we added about $1 trillion to the balance sheet, right? We called for some headlines called the end of capitalism as we know it. And in that event, we added about $1 trillion of new currency sent out in the marketplace and committed to buying between $50 and $100 billion per month for the bunch of months. So that got us through. Markets operated okay, banks were fine. 2011 happened, 12 happened, 13 happened. Balance sheet keeps growing, more money out in the marketplace. Start to slow this thing down. You see that curve start to turn over. And then all of a sudden, COVID-19 happens, the unexpected event. What happens? People start to contract. Banks start to pull back a little bit. Federal Reserve goes, aha, we've got that tool. Let's turn on the tool and let's print more. And almost overnight, they create roughly $5 trillion of new cash that they send out in the marketplace. And at the same time, with that and fiscal stimulus, they create, depending on which budget office you believe, 12, 13, $15 trillion of new cash. right? Literally dropped into checking accounts, sent into mailboxes, purchased from bond markets, lots of cash flooding the system. Imagine for a moment that the world is exactly the same amount of production, same amount of cars, same amount of people, nothing's changed. And I take all the dollars in the United States and the world, all the US dollars, and I put them on one table. And I now add 40% more dollars. What happens? Nothing, except for those dollars are worth less. Go back to my bread example. All that's happened is that we've added so much more currency, dollar bills, that the value of those dollars has declined, and that manifests itself by an increase in prices, which is what we call inflation. So 60%, roughly, in my view, of the inflation that took place comes from the fact that we've created more currency. We have not created more currency in this speed since the Revolutionary War, right? The speed at which we created new dollars was remarkable, truly, truly remarkable, a true monetary experiment, and it worked. Mostly, except for inflation reared its ugly head. Banking system worked, growth happened, people kept borrowing money. We're going to come back to the consequences of that in just a moment. Okay. Not coincidentally, home prices went up. You've all heard that before. If you own a home, you felt that. Your home price has likely gone up, benefited from that. Yes, there were geographic changes. People moved to the South, for example, moved to Texas. But what are homes priced in? They're priced in dollars. What happened as we went through this? The value of dollars declined. How many new dollars did we add? Roughly 40%. How much did home prices increase? Roughly 40%. Those are not coincidences. Okay, the amount of dollars that increased essentially decreased the value of that currency, which increased the price that we feel when we own a home. That is very related to the fact that the value of the currency has gone down. What does that mean? US median home prices, that's this chart. Go back to January of 2000, which is where this chart begins. The US median home price was around $170,000. Go to the beginning of 2020, January, it was around $320,000. All of a sudden, COVID hits, median home prices explode. They get up to almost $500,000. They've suddenly ticked down recently. Huge jump in median home prices. At the same time, because we really increased inflation, we therefore really increased interest rates to try to slow inflation and to compensate for inflation. Not only did home prices went up, but this is the chart that shows mortgage rates, US mortgage rates, the average 30-year fixed rate. In January of 2022, for example, mortgage rates were below 3%. There's this game everyone plays these days, it seems, which is, I got a mortgage rate that was 2.7. I got a mortgage rate that was 2.78 or 8.75. Everyone sort of loves to quote how low their rates were because rates went higher and higher and higher, 4%, 5%, 6%, 7%. So now what's happened? Inflation went up, home prices went up, mortgages went up, right? What does that mean? In 2020, if the average home price was $329,000 and the mortgage rate was 2.8%, that means before taxes and insurance, I have a monthly mortgage of around $1,100, $1,074. In 2023, home prices went up. Average home price is now $479,500. Mortgage rates go to 7%. Monthly mortgage is now $2,552. So for the average American, that's $1,478 per month, which is almost $18,000 more per year. Remember, the average American income in 2023 is around $57,000. So all of a sudden, $57,000, remember, that's gross of taxes, not net. That's the average American income. And yet mortgages have now gone up by $18,000 more per year. There has been not a more expensive time to buy a home in the last 40 years, because on a relative basis, prices have gone up, mortgages come up. We'll come on back to this in a second. What took place? What did the Fed do afterwards? Inflation goes up. They go, oops, that's a problem. We don't want that. They raise rates. This is called the Fed funds effective rate. They can't exactly directly control interest rates, but by and large, they influence them. And what you can see is they were basically zero back in 21 and 22. The Federal Reserve met 12 times. They raised rates 11 times, a very fast, not record, but very fast increase in what rates are. Things like credit cards and mortgages and car loans are all very tied to this process. So it became much more expensive to borrow money, to have credit cards, to have mortgages, to have car loans. That became much more expensive. And yet, you may ask yourself, why didn't the economy crash? Why didn't unemployment increase? If it became that much more expensive and mortgages are more expensive, why haven't home prices come down? Why is the economy still doing okay? I showed you earlier, stocks are up this year. Why has that occurred if essentially it's becoming much more expensive and there are lots of pressures going the other direction? Hold that question. We're going to come back. When the Federal Reserve raised rates, we look at something closely called money supply. And you can think of it as sort of cash, checking deposits, basically how much money is out there. The Federal Reserve doesn't control this directly, but they strongly influence it. And what you can see is this massive increase in money supply occurred when the Fed flooded the market with money and fiscal policy flooded the market with money. Huge increase in money supply. And as they pulled that all away, money supply crashed to the floor. It crashed. That typically leads inflation by about 12 to 18 months. So about 12 months ago, a little bit before that, we began saying, we think inflation has gone peak. We think it's going to start to retract because we were watching this chart. Sure enough, inflation has rolled over and it's starting to come back to earth again. That's a good thing. We'll touch on the risks of that in just a moment as well. And as you might expect, this shows real estate prices, something called the Case-Shiller Index, and the 12-month percent change. Home prices are not dropping. They are not growing as fast as they did before. And that's an important distinction. We'll touch on that in a second and what that means. Okay. Now we've talked about 2022. We've talked about where we are in 2023. We've talked about what happened, why inflation went up, what is inflation, and what's going on in real estate. Okay? Those are the three things we sort of laid the groundwork for. So now we're on the same page. You likely know more than most of the people you know on economics and markets at this point. And now we can turn the corner to what are the risks we see currently. And I'll address some questions here in a moment, like where are interest rates likely to go? What's going to happen with inflation? Things along those lines. Is it a good time to be in the market or not? We'll touch on that in just a moment as well. I have this section called the trifecta of doom. There are three things that I'm watching really, really closely. Number one, liquidity is disappearing. When the Federal Reserve raises rates, they're pulling money out of the ecosystem. You saw that money supply chart I showed you earlier, crash to the floor, right? They're pulling money out of the ecosystem, out of the economy. And when that happens, things break. So you heard a couple of months ago, Silicon Valley Bank collapse, right? Well, it really wasn't about Silicon Valley Bank. It was about liquidity was being pulled from the system. When liquidity disappears, things begin to break. Those companies that are not high quality or don't have high quality balance sheets or have too much debt will oftentimes go through trouble. And when that occurs, they have to go through bankruptcy and all sorts of problems occur. Right? So we don't know what will break. We don't know if more things will break, but when liquidity historically disappears, things begin to break. And we're watching that really, really closely. If the Federal Reserve continues to really raise rates, that increases the risk. If they sort of slow down now and think we're leaning more that direction, we may have a continued soft landing, which is where I'm tending to lean these days. We're watching that closely. Number two, to the question earlier, why hasn't the economy crashed? If mortgage rates went up and credit cards went up and car loans, it was more expensive to borrow. We're all a consumer-driven economy. Roughly 60% of the US economy is driven by the consumer. Why didn't we crash? And this is the money chart here, okay? So this shows each line represents the period following 8 different recessions. So 1970, 1973, 1980, et cetera, et cetera. And what we did was we said, This time has definitely had some unique things about it. We created this metric called excess savings. Think of it as the average consumer. How much savings do they have typically? So $1,000, $5,000, percent of income, whatever. We calculated essentially what that average savings rate is historically, and then we said, how much excess savings do they have? And what you'll notice, this one line, this big outlier, this big mountain here in the middle, that's the excess savings following the 2020 recession. And the axis along the bottom is months following the beginning of that recession, okay? So you can see 12 months after it began, 24 months, et cetera, et cetera. So what you'll notice is that 2020, again, this is in trillions of dollars, the average US consumer had $2.5 trillion of excess savings about 18 months after the recession began. As credit card payments went up, as mortgage payments went up, as all of these things became more expensive, because we had so much cash, the average American consumer said, I don't care. I have money. I can keep paying. Typically in recessions, when rates go up, it becomes more expensive to borrow and to spend. And so therefore, consumers don't borrow and they don't spend. Then companies don't receive that revenue. Then they begin to lay people off. Unemployment goes higher. Now the people that are unemployed spend less. Defaults occur, and you kind of go through this trough. You go through a recession. That hasn't happened at this time because the average consumer has had so much excess savings that they could spend through it. Well, now look where we are. Far right, 3 years hence, where the arrow points, we have now burned through that excess savings. So we are on the razor's edge, as we say. We're watching really, really closely as how does the consumer act. The US consumer is a huge portion of the economy. If they stop spending, which they really haven't yet, that will be a problem. If the Federal Reserve raises rates much more quickly, that will be a problem. Thus far, we're okay. We're watching that really, really closely. Last item in my trifecta of doom before we zoom out here is Chinese growth. So Chinese growth between 2008 and 2017, China accounted for roughly 60% of the world's growth, not China's growth, the world. China has been a huge engine of growth for the world. Okay, now always keep in mind whenever you look at Chinese growth data, any Chinese data, it's oftentimes made up. There's a lot of fictitious information coming out from China. So we proxy this with something called the Hang Seng Index, which is the Hong Kong stock market. Has a lot of Chinese listed companies. What you'll notice, remember, stock market's gone up for us, right? Very, very much gone down for China. This is a worry for us. If there's no China growth engine, then is there someone else? Could it be India? India just went into the world's third largest economy, just past Japan. US is first, China is second, now India is third. Could India fill that spot? Who could fill that spot? Could it be a clean tech revolution, an AI revolution? Lots of different possibilities, but we need growth in order for the economy to continue to drive markets, right? Capital markets, stock markets, bond markets are just a reflection of capitalism, which is basically the system by which we run our economy. It's not perfect, it has a lot of flaws, but it's the best system we know for taking capital from savers, earners like you, providing it to companies to do productive things, and in exchange, you receive a return on that capital, a return of your capital, and over time, you will generally make positive returns over time. But there's some risks right now. So we're watching those really, really closely. Summarized that as when liquidity and growth disappear, handful of points. Number one, maintain caution with equity markets, okay? This is not the time to go out and take a bunch of risk. Interesting opportunities, but be careful. Focus on the long term. Number two, long duration. I mean long duration, I mean the bond market. As rates have gone up, it's more attractive now than it was 2 years ago, 3 years ago. So it's looking more and more attractive. Real estate, especially commercial, has challenges. There's a bunch of sort of hanging, scary things that are out there a couple of years out. We're watching those closely. Some interesting opportunities be created in alternatives as well. Lastly, sort of avoid cash. When inflation is this high, sometimes it can be not a great investment. There are good emotional reasons to hold cash or short-term needs, but If inflation is this high and you're earning 0% on your cash, but inflation is 5%, you're basically losing 5% purchasing power per year. So be careful about that. Try to make sure that you're investing in dollars. Okay. So that's sort of tactical, short term here, things to think about. Always very important. Make sure you have a plan in place. Work on that plan. If you don't have one in place, stick to that plan. Work with your advisor to make sure that you're focused on those plans. Candidly, that's one of the best things advisors do, is just help create that plan so we can stick to it and focus on the long term. Which gets us to the last section. I know I've said a lot. Bear with me. We're almost done. Let's zoom out for a moment. So this is the information that you hear on a daily basis. Okay, this is bad news sells. We have this part of our brain, there's a prefrontal cortex and something called an amygdala, that essentially reacts very strongly, disproportionately, in fact, to bad news. So imagine we're walking down the street and you look at a newspaper stand and there's two newspapers. One of them says, hey, the world is ending. The other one says, everything's great. Go about your day. Everything's normal. Which newspaper are you likely going to pick up? You're going to pick up the world is ending newspaper, right? That's the way our brains are wired. And our brains have been built that way biologically for very good reasons. It helps us survive. It helps us make risk avoidant decisions. That's why press, CNBC, Fortune, Forbes, all of them, you name it, really rely heavily on bad news because it sells. It makes you look at the TV. It makes you look at the newspaper. So I keep this file of bad news headlines, and literally it's almost every single day. So here are some that I called out. Dow will fall to 6,300 by year end. Dow could crash to 3,000. Here comes the biggest stock market crash in a generation, right? And I've overlaid those over the stock market. You start with $1 back in 2009. You've got $5 today, right? It's gone up 5 times over this time period. Yeah, we've had some big crashes and some big sell-offs, but boy, most of these headlines are very, very wrong, right? Over time, capitalism works, not in the short term, but in the long term, it works. So keep that in mind. You're inundated with bad information. You're inundated with terror. You're inundated with horrible things to say because it sells, right? But we should always be able to zoom out. Last couple of charts. Economy, U.S. growth. This is the 12-month % change in U.S. real growth. It's growing. The economy's fine, right? Is it as strong as it could be? No. It could be weaker? Absolutely. So this shows sort of between 0 and 2%, 0 and 4% for the sort of normal periods. Recessions, you can see, drop below 0. But look where we are now. Blur your eyes, and we're kind of in the middle. Things are fine. U.S. economy is still doing okay. It's actually done quite well. Unemployment rate, that's this chart, goes back to January of 1990. What do you notice? U.S. unemployment is low. People are working. People have jobs. When people have jobs, they receive income. When they have income, they spend. When they spend, they borrow. Companies receive revenue. It's that full cycle. So far, when there's been some layoffs at different tech companies in a couple of different areas, and there always will be, but job market's been pretty strong. So if that continues to be the case, we'll likely be okay, and it'll be a soft landing. Again, those trifecta of doom points I'm watching closely, but there's always risks. We as an economy have gone through wars and pandemics and terrible decisions and terrible policies and all of those things, but over the long term, capital markets are efficient at allocating returns. Last couple of charts, again, zoom out, start with $1 back in 2018. You've got $2, 2023, right? Great growth. Markets are up over this time period. All the craziness that's gone on, markets tend to go from bottom left to top right. Last 2 charts, one of my favorite. Again, I mentioned at the beginning, I'm a simple person. I like simple charts. Red dots, blue bars. This shows every single year from 1980 up until 2022. Let's focus on the red dots first. That shows for each individual year, the intra-year worst decline. So in other words, in 1980, stock market fell 17%. 1981, it fell 18%. 1982, it fell 17%, right? What you notice, each one, great stories, really interesting anecdotes. Blur your eyes for a moment. What do you notice is that almost every year the stock market falls. We should expect the stock market to fall. When it does, don't panic. It's oftentimes a buying opportunity, candidly. But every single year the stock market falls. Blue bars That shows the calendar year return. January 1 to 12/31. 1980, stock market fell 17%, but for the year, it was up 26%. Yeah, there's some years that are down, but on average, markets go up over time and do so quite significantly. Last chart, and then I will stop talking, I promise. Growth of $10,000 over this full time period from 1980 is an 8,687% return in the US stock market, including dividends. You start with $10,000 back in 1980, don't put another dollar in ever, you end up with roughly $450,000, right? And that's despite these red circles I've called out. Stock market was down 28% in 81 when Volcker came into office, break the back of inflation. 87 crash, stock market was down 20.5% in one day. Dot-com bubble, global financial crisis, flash crash, recessions, you name it, right? COVID. Over the long term, those hysteric panics, the things that were so horrific at the time, blend into the background. Right? We focus on the long term. That's the only thing we can really control. Keep expenses low, keep taxes low, try to diversify as much as you can, stay invested, resist the very real urge to try to time the market. If you look at the last 40 years, the stock market has given us 10.7%, but the average US stock market investor has received 7%. That's a huge difference, 3.6% difference. Why? It's oftentimes because individual investors are buying at the wrong time. When things feel great, there's a lot of exuberance, everyone's happy. That's oftentimes the wrong time to buy. When things feel awful, everyone's fearful. It's oftentimes a great time to buy. We do the exact opposite. That's why the best thing you can do is just stay invested, focus on the long term, focus on the long-term growth of those assets. And with that, I'm done. I hope I haven't put you all to sleep. I'm happy to take a couple of questions. I know it's I think roughly on 45 minutes here, pretty close. Happy to take up questions. Often as folks want to ask questions too, which is totally fine. You are welcome to email your advisors, email me directly, and I do answer all of these emails that come through, so I'm happy to engage there as well. So with that, Holly, Andrew, we want to maybe curate questions or see what's come in, or if you have any.
Yeah, I've got a couple on my desk now.
Sure.
If you guys want to email Holly or myself or reply to the email Sharon sent before, we can add some questions to the list. I think the first one was about inflation. Somebody just wants to know, what is inflation currently? And then I have a quick follow-up. What measure do you like? So I'll
good question. So I'll take them in reverse order.
Okay.
So CPI has a bunch of problems with the way that it's measured. I like something called PCE, which stands for personal consumption expenditures. Basically, what happens and the way this is measured is the department that measures this, U.S. government agency, assumes a basket of goods, sort of picture in your mind a grocery basket, and they put in there paper towels and bread and everything else, but they also put in there something called homeowner's equivalent or renter's equivalent, which is how much does it cost to live, what is health insurance, and there's a lot of weedy details in there, but the short version is there's some really funky biases in the CPI. It's not perfect. It's okay. The PCE is a little bit more of a reliable indicator. In fact, the Federal Reserve uses PCE, so I like that one better. Inflation, was as in the UK, and it depends on which measure you look at. Inflation is using the measures that I like, sort of in the 5.5% ballpark right now. UK was up to 11%, has now fallen. We had a bad tick a couple of days ago. So numbers were up a little bit closer to 6, but it's in that ballpark right now.
Okay, very good. I've got another one, and this is a good one. I've been getting this in some client meetings lately, and it's a very good question. But I'm curious to see how you would handle it. It's if cash is paying in the 4 to 6% range, why is it so bad to keep it there?
If you're earning 4 to 6, and if your cash is in a safe place, it is not bad to keep it there. If you're earning 0, it is very bad to keep it there. So a lot of liquid accounts like checking accounts and some savings accounts pay you almost nothing. That's what I was referring to specifically. If you take the 2-year treasury, the 10-year treasury, the stock market, even some of the short-term yielding stuff, and you put it all in yield terms, and I have a chart that references this in another deck, they're all interestingly right around the same. They're around 5% right now. So that, as long as you're in a safe place and you're FDIC insured, or you're in a really safe place like MassMutual, then it's totally fine. And I'm happy with you doing that. I just don't want you to earn zero when inflation is at 5 or 6%.
Okay, good.
Daken, I have one. So, you touched on a little bit, but the real estate thing that's coming next year.
Yeah.
Regarding commercial real estate and leases, and notes that are, leases that are coming due.
Yeah.
And a lot of abandonment of some of the commercial buildings. What do you see coming with regard to that?
So, okay, let me try to provide a little context. So in the commercial space, when you buy a property, you're your insurance firm that buys a property, you're a pension plan that buys a property, you're a real estate firm that buys a property, right? You buy the property, you oftentimes will lease out the individual offices or floors, right? Retail space, you name it, office space. And you calculate what's called a cap rate, which essentially, think of it almost like a yield. So if I buy an office building for $100 and it gives me 5%, $5 per year, right? That's a 5% yield. So I sort of can think of that. I'm simplifying a little bit, but by and large, that's how you can think about kind of commercial real estate. What's the cap rate? What am I earning? Well, if I look at commercial real estate over the years, those rates have gone down and down and down. As more liquidity has come in, more dollars, more people chasing real estate, the rates that were being earned have gone down and down and down and down and down. The problem is a lot of people who have owned that commercial real estate, if you look at kind of the distribution of when refinances take place, a lot of dollars are coming due in the next couple of years. If you're a real estate owner that's, let's say, has locked in long-term leases at a 3% cap rate, right? So you're earning 3 or 4%, but you've got to refinance your real estate ownership, and those rates are 7% or 8%. You're earning 3%, you got to pay 8%. You don't want that office space anymore. It's a bad deal. So what's going to happen? A couple things. One is those that have commercial real estate ownership or holdings are oftentimes realizing they're underwater. They're already in the red. And a lot of those folks can be leveraged, which can be very painful because you now have hundreds of dollars of exposure for every $100 of cash that you actually have. And that can go bad very quickly. That's one. Two, they can essentially say, I don't want this property anymore. And when they go through that process, they could go to the market and sell it. If you have a lot of people who are selling commercial real estate at the same time, you put a lot of pressure on prices, which puts further pressure on those that already own it. So when you look at the distribution of when all of this is happening over the next couple of years, you realize a lot of real estate is coming due, a lot of refinancing is coming due in the commercial space, and a lot of folks are underwater. We've run some numbers, and we don't think it's a big enough risk to cause any systemic exposure for the economy, but it's a tricky time to hold commercial real estate. And if you're in the commercial real estate space, it's a tough time because things are underwater. There's not a lot of transactions that take place. It's almost like Japan in the 80s, where we've got to wash a bunch of this out and candidly have some defaults for prices to reset and rates to reset. And so that's the thing I mentioned or was trying to expand
on. One other just finer point. In the beginning, when you were going over the money supply and you were showing the $1 trillion versus the more recent $9 trillion.
Yeah, I'll jump back there. This.
Yes. How does that relate to the M2 money supply?
Yeah, good question. So there are a handful of things. If you think about sort of the mouth of the river, or think of a river analogy for a moment, the Federal Reserve can sort of influence how much water is going in, and a little bit of the width of the river, but there's a lot of other inputs too. Banks, for example, can determine how much credit do they want to offer. A bank can tomorrow say, I don't want to lend people any more money. And that's a form of money that they're lending. So there's a lot of inputs into what that looks like. And the Federal Reserve balance sheet, by sending dollars out into the marketplace, puts a lot more water in that river, to stick with this analogy for a moment. And so money supply expands, but there are other factors that contribute to that. Banks have to be willing participants to continue to lend. And if all of a sudden banks start to see this go the other way, where they go, oops, it looks like the Fed could push us into a recession, a bank is now very worried about the people they've lent money to, because a bank doesn't want their lenders to default or their borrowers to default. So then they'll start to pull back lending and they won't lend as much. So they're very related, but they're not one-to-one relationships. So we watch both very closely, because if banks become sort of reckless, you could see M2 spike, even though the US Federal Reserve, however, hasn't done anything at all. So we just watch those because they're both inputs into this money supply idea.
And then one more, just speaking about banks, what kind of stress do you see coming for banks, if any?
A lot of the changes that took place following Dodd-Frank, global financial crisis, some of the proprietary trading, the Volcker rule, things like that, they put our US banking system into a better place. But no matter how much regulation we have, US banks are built on something called a fractional reserve banking system, which means they do not have to have all dollars at the bank at all times, meaning they lend a lot of money out and they have a small amount of money sitting in their vaults on any given day. That's the way that banks make money. That's the economic model. That's why the Federal Reserve exists, candidly, to back them up. But on any given day, you can have a bank run like what happened at Silicon Valley Bank. So this is the time right now when you want to make sure that you've got your cash at safe places. And I think of that both in terms of banking, but also in terms of insurance. So an example is Florida right now has got a massive shortfall on property and casualty providers because of Hurricane Ian that took place last year, because of some stuff that happened in Europe with some lenders or some of the insurance firms that pulled back. So if you're in Florida and you own a property, a second home or a primary home, this is not the time you want to use a small insurance firm necessarily, because there are credit risks there. And the same idea goes for banks. You want to make sure you're FDIC insured. You want to have your money at places that are very safe. If things get worse, and candidly, I'm pretty optimistic that we'll go through a pretty soft landing based on what I'm seeing today. But if they were to get worse, you always want to make sure your cash, your hard-earned cash, the money that you actually have worked for, is at a place that is safe and has been through some of these crises. Not getting a little bit more yield for a lot more credit risk. It's just not worth it. It's candidly, it's one of the reasons I joined MassMutual. We don't take proprietary trading risk. We don't explode our balance sheet. We don't do all of the stuff that a lot of the prop and big sort of Wall Street bulge bracket firms do. And that's a safe place to keep cash. And you should make sure that your cash in these kind of riskier times is at a stable, safe place that you can sort of sleep at night and not worry about those same kind of risks.
I got a quick follow-up to that, if you don't mind.
Sure. Yeah, of course.
So one of my questions was, how should we think about bonds moving forward? Because you mentioned credit risk.
Sorry.
And I always see those as challenges in our managed portfolios, because they're obviously there to manage risk. But we saw last year that big drop. And so we've a lot of times, and Holly and I have been proactive last several years about trying to find alternatives to that market for fixed yields. What do you see about that moving forward, and what alternatives exist to?
Good question. So I'll start with the summary this time instead of the preamble. So the summary I feel right now is, if there's odds are, in my opinion, that yields, let's call it the 10-year for a moment, yields either stay flat or go down a little bit. I think that's more likely that happens than they go up a lot right now. And when yields go up is when bonds go down. That's when people take losses. The reason is that we saw this huge growth in money supply. That's crashed down. Federal Reserve raised rates really quickly. They're unlikely to lower rates really quickly. They're unlikely, unless we go through something unique, to spend a bunch of money and provide a bunch of cash. So it's a little bit of an asymmetric exposure right now. I think rates will likely sort of stay where they are, or drop a little bit, bounce up a little bit, but not spike. That's barring any big crisis or any major change by the Federal Reserve policy. But based on that, I lean towards that direction, which I think puts us in a place where it's a pretty good time to own a heck of a lot better time than 2 or 3 years ago to own, 10-year bonds, 7-year bonds, 5-year bonds, even 2-year bonds. I mean, you get a lot of yield without a lot of risk. You just run some reinvestment risk. So that's kind of one thought on the direction. We're very careful to not be arrogant enough to think we can call the market, but we will say, we think we can lean a little bit more one way or the other. I think that's the way we're leaning right now in our portfolios too. In terms of other things to hold, now that the market has settled down a little bit, holding inflation-linked bonds is an interesting thing to have in a portfolio sometimes. I think a lot of folks regret that they didn't hold more tips or those kind of things in a portfolio. So that can be a way to get exposure. There are some problems there, but that's an interesting space. We have some alternatives that we have a BDC strategy for high net worth clients that can yield somewhere between 8 and 11%. That's one that you should look at some point for high net worth clients who are interested in that one. We built a high yield strategy that holds REITs and preferreds and a bunch of other things that we're happy to talk about with you as well. Very inexpensive cost, good tax profile, and can be a good way to get additional sort of diversifying yields. We've got a bunch of things that are out there also. At the end of the day, there's a lot of stuff yielding kind of between 4 and 7%. Just make sure that the extra bit of yield you're getting is worth that credit risk, because there's a lot of stuff that's a little bit better, but you're getting a lot more risk, and that's clearly the wrong trade-off right now.
Daken, I was just going to add one more comment.
Sure.
Back on what Andrew asked about cash earlier and what's wrong with holding cash. I'm getting the same thing from a lot of clients. Man, this is so fun. We can go put money in cash accounts and CDs and high yield money markets. And for the first time in years, we're earning money.
Yeah.
And the only thing that I've cautioned people on is not to get too excessive, over and above their emergency money and short-term spending needs, because eventually, if those rates come down, they're going to have to reinvest that money in lower rates.
That's right.
And now might be a fabulous time to buy some high quality insured municipal bonds, for example, and lock those rates in that are high right now for, like you said, a 7 to 10 year period. Take advantage of that instead of just going with the day to day. Because, for example, I had a client years ago that came in the 90s when CD rates were 4 and 5%, and they were very reluctant to buy bonds because the rates were a little bit lower. But then they watched their interest rates go down, 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 down every year, and they were trying to live off of that interest. And their lifestyle went down because they had less and less money.
Right.
And so bonds can be a great way to diversify, especially now compared to, like you said, a few years ago.
I absolutely agree with that point. That reinvestment risk is a big risk, and I totally agree with that. I think that's a great thing to point out, Holly. I should have mentioned that as well.
Yeah, so it's like you're diversifying the length of that locking in. You have some of that cash in those high yield savings, but you start laddering up to lock it in. Okay,
exactly.
Awesome. Very good. All right. Well, I think we're right about at the end of time. Holly, if you didn't have anything else, I think we can wrap and send Daken on his way. Guys, if you have any questions, please email us, and Daken's been kind of have us forward those, and he can reply to those when he has an opportunity. But we want to thank you for joining us, Daken. It's been great.
Thank you. We appreciate you so much.
Yeah. Great. Bye.
Bye-bye.